Hello and welcome to High Probability Candlestick Reversal Patterns, lighting the way to better entries. Before we get started, I want to direct your attention to the risk disclaimer on our screen to make sure you understand all the risks associated with foreign exchange trading. In this video, you will learn which are the best reversal candlestick patterns to trade. Japanese candlestick patterns have existed for centuries. Japanese rice merchants use candlesticks to help them predict and profit from price changes. The writings of Munehisa Homa, a Japanese businessman, were the first detailed documentation of the use of candlesticks in the 18th century. Homa tracked rice contracts using candlesticks. He tracked the opening price of the day, called the open, the lowest price of the day, called the low, and the closing price of the day, called the close. Armed with this information, he could analyze fear, greed, and the herd mentality. He observed repeating patterns that led to price rises and price declines. In fact, he's quoted in 1755 saying, "Buys and sells are decided on emotion, not logic." Now, back in 1755, it is estimated that Munehisa Homa made $10 billion in today's dollars. So it's worth to take a listen to why he used candlestick reversal patterns in his trading. Now, Steve Nissen is credited for bringing Japanese candlestick charting to the Western world in 1991. Prior to that time, Western traders used bars and line charting exclusively, while the Japanese were using candlestick charting, and they were constantly making more money than the Western, the European, American traders were. So he went over to Japan to find out what was their secret. Now, Candlestick Basics. A candlestick is composed of an upper shadow and upper and lower wick and a real body. A candlestick is bullish if the closing price is higher than the opening price. So price starts here and closes here. That is bullish. Whether it's a 5-minute candle or a 15-minute candle or whatever period time frame you use for a candlestick, this represents one period in which the bulls are in control because they've taken price from the open to the close. Now, usually you can denote a bullish candle with a green candle, but you can make the candlesticks any way, any color you want. Now, the bearish candle is when the closing price is lower than the opening price. So price opens here, but then at the end of the period of time, it closes down here, which shows that the sellers are in control. And so we would call this a bearish candle, denoted by this red color. So we can use that to our advantage. Now, candlesticks themselves, there are hundreds of candlestick patterns with exotic names and complex formations. In modern electronic trading, many of these patterns have a very low accuracy. However, according to the author of the Encyclopedia of Chart Patterns, Thomas Bulkowski, there are certain chart patterns that have a high degree of accuracy. When you learn these patterns, you'll be able to cash in on candlesticks. There are 6 bullish reversal patterns that traders should learn and take notice when they appear at or near a level of significant support and resistance, such as Fibonacci or pivots, or classic support and resistance bankers level 0025. You can find out about those in other videos. The first candlestick pattern is the bullish Harami. It has a large, wide body and a small body candle inside the body of the candle. Then the bullish engulfing, which is a small body candle, but with a large body candle engulfing it. Then there's a hammer with a small body and a wick. There's a doji morning star, a bearish candle with a small real body, narrow body called a doji, followed by a bullish breakout candle. And there's a morning star candle, which is similar to the doji morning star, has a bearish candle followed by a spinning top at its center, and then a breakout candle. Then there's a tweezer bottom where we have 2 candles side by side at support and resistance. This bearish candle followed by a similar size candle. They can have the same wick, or they could be flat bottoms candle with no wick, but it shows that the bulls are gaining control. And we'll show some examples of these candles in the next videos. So here we go. Here's a Harami. There is usually it's in a downtrend followed by a bullish, like a reversal candle, but it's inside the body of the candle. Okay. And so this is a reversal pattern, and we see a new candle that appears just above it. That's where we would enter long. And we can see the trend, a new uptrend, continued after that. So when we see this kind of candlestick and we're short, we want to be on alert to either switch our position and get long, or if we're waiting for this candlestick to finish, we're able to get long on this particular trade. Okay. The next pattern we're going to look at is bullish engulfing. Usually occurs in a downtrend. Then we have a large candle that closes above the previous candle action, and then new candles form in an uptrend, which reverses the previous downtrend. The next one we're going to look at is the hammer. The hammer candle is found in a downtrend as a small real body and a long wick. The wick is usually 2 times as big as the small body. It first starts off as a full body bearish red candle, but buyers step in, making that shadow, that wick, very long, and prices reverse. And we want to be buyers above the high of that candle. The next candlestick pattern is the bullish morning star, where we have a bearish candle, a downtrend forming, a small body doji, which looks like a cross, and then we see a breakout candle that breaks above the high of the doji. We want to be buyers above that high of that doji, and we want to notice where this is occurring as far as support and resistance levels are showing up. Here's the morning star pattern, which is it's similar to the doji morning star. It has a bearish trend, and then it ends up with a small body called a spinning top, and we see a reversal candlestick pattern, or reversal candlestick forming above the high of the spinning top, and that's where we want to enter long at 0.5, and we can see a trend, a reversal trend happening. So when we see prices basically slowing down and compressing, usually prices reverse after a compression. The next candlestick pattern we're going to look at is the tweezer bottom. Tweezer bottom is found at the end of a downtrend when we have 2 candles of near equal size. They can either have 2 wicks or they can have 2 flat bottoms, but then they happen side by side. Sometimes they call them twin towers or railroad tracks. And we see a new candle that breaks above it. On the break above, we want to enter long so we can catch the reverse and catch that trend. So those are the bullish candles. Let's look at the bearish candles. And there are 6 bearish reversal patterns that traders should learn and take notice when they appear at a level of significant, basically significant resistance. Okay. So we can see we have the bearish Harami, the bearish engulfing, the shooting star, the doji evening star, the evening star, and the tweezer top. First one we're going to look at is the bearish Harami. We have a large bullish candle. It's a 2 candle pattern. The bearish candle that's inside the body of the big bullish candle is a reversal candlestick pattern. And usually we want to get short when price breaks below the low of that candle, and then we look for prices to continue down. We look for this to occur at a significant level of support, or actually a significant level of resistance. Okay. The next candlestick pattern we're going to take a look at is the bearish engulfing pattern, which is found at the top of an uptrend. It's hitting a significant level of resistance, and we see a bearish candle that engulfs the previous body or previous candle, and we want to get short on the very next candle. We just go ahead and get short with a stop above the previous high, and we look for a reversal because the momentum has changed. It shows the sellers are in control, the bears are in control, and so we want to ride that move down when we see a bearish engulfing. The next candlestick pattern you want to look at is the shooting star. The shooting star is found at the top of an uptrend as a long shadow or wick, as shown here, followed by a small body. The wick is usually 2 times the size of the body, and we want to get short on a break below the bottom of the shooting star pattern so we can take advantage of the change in momentum, the change of control of the bears or the sellers are taking control here. And the shooting star actually starts off as a bullish candle, and then it shrinks, leaving that wick. So we might even see that look bullish initially, but maybe a few more minutes or a little bit more time it lapses, and that bullish candle becomes a shrinking violet and gets really small and just leaves that wick behind. Next candlestick pattern is the evening star. Evening star pattern is a 3-candle pattern. It happens at the top of an uptrend. Bullish candle followed by a small body candle like a spinning top, followed by a bearish candle that breaks the low of that previous candle. And we want to get short right there to take advantage of the sellers taking control. The tweezer top pattern is a reverse of our tweezer bottom pattern, where we have at a significant level of resistance 2 candles that have a similar shape. They either have the same wick, they have the same high, and they're bouncing up against resistance. We want to sell on a break below the pattern, and you see that price falls after that. Then we have the doji morning star, usually found at the end of an uptrend, small body like a cross that's formed. And then we want to sell the break of the bottom of that doji, which turns into the reversal of the trend. Now, we talked about 2 types of candles. We talked about the selling candles, or the bearish ones, and the bullish ones, which are the buying candles. But there's another family of candles called the neutral or indecision candles, and these are the dojis and spinning tops. They indicate a tie between the buyers, the bulls, and the sellers, the bears, because the body, the open and the closing prices are they're like small. They can either lead to a reversal or retrace of trend direction, or they can lead to a continuation of trend direction. By themselves indicate a pause in the action before an explosive move. The doji is much like a coiled spring that is compressed. The distance between the opening and closing price is very small, or in some cases non-existent. This leads to an explosive move. Over time, this could lead to the explosive move in one direction or another. This phenomenon is called volatility compression, or low vol, where we have 2 small dojis. You can see 2 days, 24 hours, 48 hours of sideways consolidation, compression, and then boom, a breakout. Then a continuation of trend, and then boom, another compression for another breakout. And we don't know which direction it could go from there, but we just are on the call that either we're going to break above the high of this cross or break below the low of the cross. Now remember that candlestick patterns can show up any place on a chart. However, only when these patterns appear as significant areas of support and resistance should a trader take notice. Learning to identify these high probability candlestick reversal patterns will help you locate low risk, high reward trading setups when you combine them with good money management. If you have any questions, email support@elitetradersu.com.